Special report, March 9th, 2020, markets in chaos. Well, the markets are having historic moves with a convergence of issues hitting all at once. We're going to talk about where we are now in the major markets and what could happen next, and even make some comments about can what got us here be fixed? Well, the coronavirus, COVID-19, has been the trigger for a worldwide slowdown and a very challenging and difficult condition all over the world. The smoke really has been clearing on what was a cloud on some huge problems out there that are now exposed. The cases of coronavirus growing has caused a lot of countries to take actions that are really badly affecting their businesses. And when you look at Italy, it has now quarantined 25% of its population. Cases in the US are moving up, but compared to other countries, there are relatively few. Still, sadly, there has been some deaths, and there is the risk that it's going to increase significantly here in the US also. What really happened today and caused the markets to move down incredibly sharply with limit down moves overnight and then second limits hit when the markets opened up, and now as I'm doing this recording, the S&P 500 down over 7%. That's down 227 points on the day just as we are starting this right now. It is certainly a chaotic condition. And the energy that caused this today was the failure of OPEC. Yes, OPEC now goes into a price war as this started because the OPEC meeting did not bring anything that looked like any potential at all for cutting production. And that's because they had already cut production. And the fact that Russia didn't want to go for anything more set up Saudi Arabia to just say, okay, we're just going to produce a ton of oil. And the price collapsed in the energy market. We have energy stocks down very significantly right now on the day, some 30 or 40% declines on some of these stocks in the day. And that is the group that is getting hit the biggest in the stock market. We have the failure of OPEC causing a lot of potential disruption in markets that are involved in energy, and we have a lot of companies in the shale industry that at this price are just potentially out of business. We're seeing the high-grade corporate yields, that market HYG collapsing, and I showed that in a video just a couple of days ago. And the stock market now down approaching 20%, the Russell down more like about 23%. And the devastation that we're seeing in the market in just a mere 13 trading sessions is historic. We have the bond market in a massive flight to safety. At one point, the 30-year bonds were up over 8 points overnight. The 30-year yields fell as low as 0.83. That's a 30-year yield. With the 10-year yields down under 0.4, the entire yield curve right now down under about 90 basis points. This is a very historic condition that we're seeing in here. I'm going to keep using that word because I have a right to. I'm historic in that I have been here for 45 years trading this markets. I've seen markets that crashed. I traded the crash of 87. I even traded the bear market in 1974, if you can imagine that. So I've been around. I've seen a lot. This is a very critical condition that the market is in right now. And we have this morning the Fed having added some liquidity into the market. I'm still waiting to hear if they're going to do anything else special. But there are very large disruptions, and I am hearing that the bond market is highly illiquid with very wide bid asks in there, and of course the energy market putting huge stress on the bond market, as the bonds have been a major flight to safety. Other flight to safety things you might expect: gold, well, it got a pop and it pulled back, now trading about unchanged on the day. We're going to talk about that as we look at some charts in here. When we try to look forward in what is going on in these markets right now. So flight to safety in the bond market, of course. Massive moves out of the dollar down a full penny again. The Japanese yen absolutely exploding. It was our trade that we thought really was going to be happening before. The dollar just held up a little longer than we expected. There is a lot to talk about and a lot to show you, but I can't possibly do a recording like this without talking about how we got here and what it's going to take to actually get out of this issue. It is a clear fact to me, and you can see what's going on in the markets right now as I talk about the smoke clearing and the realities of the market showing, is that the Fed, over the last 11 years in this crazy experiment that they've been in, has created a massive bubble conditions. Instead of allowing natural pricing in the markets for 11 years, instead of allowing the markets to trade organically, they have tried to, in their hubris, erase the economic cycle, and you just can't do that. In their attempt to do that, in their facade that they put on, they have done things that make energy prices trade at levels that were unrealistic. The supply-demand situation in energy was very clear, as there was constant pressure on oil prices. And any rallies, when they got over $60, well, oil shale producers could come out with their oil. And the U.S. ability to produce oil has greatly expanded, becoming the number one producer, and that has left the supply-demand situation really negative. And oil should have been coming down before anyway. But now all of these oil companies that were very marginal and borrowed tons of money, they're in massive trouble. They shouldn't have been able to even be there or be in business. If you look back to how the government saved the markets back in 2008, 2009, by massive amount of printing, taking on a huge amount of money in their balance sheet, print, lower interest rates, manipulate the markets. They created false earnings all across the board, a false economy all across the board. Now what we're seeing happening as the markets are just absolutely coming apart, are the realities of that, and the fact that earnings are not real and these valuations are not real. And if you go watch the special video I did a few weeks ago in the big picture on the stock market, you will see I talked about 6 secular market cycles in which the stock market rallied at the end, its final rally, some 12 to 15 months, getting up 35, 45%. Well, this one got up 44% in about 13, 14 months. And now we have a major top in place. So, what could we do instead of allowing the markets? Instead of allowing the Fed to do what it does, is for it to allow a purge, allow the real things to happen in the market. With this overpricing in energy very clear now, the false economic conditions that created it, we have that in all of the markets right now. So now reality is here. And it's the same thing for all companies, not just the energy companies. Of course, a lot of companies have unique situations, and a lot of companies have earnings that are based on a bubble that the Fed created. What is the best thing that the Fed could do now? Well, the best thing the Fed could do now is take no action whatsoever. Let the market sort it out. No bailouts at all, not like they did in 2000, 2008. Let over-leveraged companies fail and help them. Help them go out of business if that's what the government's role is in managing them, or even some banks. Though the banks really are in better shape than they were, and we may not have banking issues at all. And let's let this thing all play out and sort itself out. Allow a purge and admit, Fed, that you created this situation by this manipulation, and let's get the Fed to have a role that is much different. Well, I just talked about fantasy land, and that's not going to happen because they would much rather try to avoid the pain and not deal with the issues, the problems that they created. So that's a bit of my rant in here, but we have a situation that they created, and that's why I think that their markets now are punishing them. They've been the bad players. The markets are taking over. There's hardly a way that they can avoid cutting interest rates another 50 or 75 basis points. We're probably going to negative interest rate policy here in this country, and this sorting out of this issue is going to take a long time. So those of you that are looking at analysts that are saying, okay, just let the dust settle, we'll find some values to buy, all of that. Well, in some groups that's going to be true. In some stocks that's going to be true. And in rebounds that's going to look right. But those rebounds are not likely to be able to last anywhere as long as you would think. And by the time they're falling again, if you haven't taken profits on bounces or liquidated out of positions, we warned about that weeks ago. It was time to change allocations. But if you're not fast at doing that on rebounds, there's a good chance you're going to miss those opportunities. So that is my opening to what is really meant to be looking at charts. We're going to show this to the public, even though it would normally be a members video, because I want you to hear it, and I want you to see the charts we're looking at, and especially the uniqueness of how we analyze the markets and how we're going to come to some conclusions of what we expect to happen, with some general focus right now on just looking at the near term, short term, the next 1 to 3 weeks. Though I'm going to show you more charts than that, because I want you to see the type of analysis that I do, that we do here at Ask Slim, and I want to give you the opportunity to contact us about memberships and stuff like that. So yes, this part of this is because I want the world to hear what's going on in some reality, and I also want the world to see the way we analyze things and why we were negative in a lot of things, and what and how that supports what we're looking at going forward. So I'm going to give you a good look at some of the charts I don't normally share except for level 3 and 4 members here at Ask Slim. And again, this is going to be shown to everybody. So let's switch over right now to the charts, and we're going to start out by looking at light crude. This is the light crude chart, and we're looking at a 10-year weekly chart right there. And what we're going back to is 2016. And just so that you understand the type of analysis we do, this is cycle analysis. This is a 10-year weekly chart, though we're only looking back about 5 years, or a little less. And I want you to notice these half cycles, these half moons on the bottom. These are called cycle brackets. Each one of these big ones is made up of 4 smaller ones. These are minor quarter cycles in here on these weekly charts that we're looking at. And there is a very clear cyclicality in here that I want you to notice. And that is that each of these big ones right in here is made up of 4 smaller cycles that are quite visible in here. So these minor quarters are significant. When you get to the final stages of a cycle, where they nest, the small one and the big one, is where you often have your largest declines. You can see this one right in here as oil fell from about 53 to about 42. You can see this one right over here where they nested, and oil fell from this peak here at 77 down to this level over here at about 42. And I want you to note that this decline comes in the third cycle right over here after the breakdown. Now I want to just look at this bigger cycle right in here so that you can see what we're looking at. And what our charts showed us was that there was some resistance up here and that these cycles were moving basically sideways. You can see that right in here. And when this one broke down below that key cycle support, it set up this major break. We alerted that this wasn't a good thing when it broke there and there was downside risk. There is no way we could have known, other than the risky period in here, that there was a potential for a decline. In fact, our analysis was suggestive of the fact that there was a bottoming likely to come in here, but we didn't understand that OPEC was going to fail and there was going to be a capitulation. Now we're down at the bottom of this third cycle that you can see there, with a likelihood that there's going to be a rally. Now, resistances in here are about at this area of about 36.5 for that lower intermediate 23 that you see there. That is, just put this back in place right over here, that is the 23.6% upward correction of this entire distance to this overnight low down here that was under 28. So that gives you a potential rally period in here, but remember, we're coming into this fourth cycle, and it means that this sell zone in here is likely to stop any kind of a rally, and they're going to be moving down sharply again. So there's a major cycle support right over here at about $26 there. That would, this one right over here is the intermediate 100% fib extension. It got through there, right there. It's possible that, it would hold if it rallied, but it's much more likely that we're going to fall to $26 or lower. I just want to note that Goldman must be looking at the same chart, because Goldman is calling for a price of $25. So it got down into the 27s overnight. We're rallied back somewhat right now, down 10% on the day. 24% on the day, $10. And our projection would be probably moving down into July. Now, July is a time period we expect the stock market to be making a bottom also. So this is kind of in line. We call that synchronicity in markets. And a move down to 26 is likely. What does that say about the market? It says that this whole period over here into the summer, spring and summer, has got a ton of risk and rallies are likely to fail. Now that's the weekly chart. Let's move into the daily chart right over here, and you can just see, let me just look at these last three cycles right in here. What we're looking at is this one right in here, actually late on this capitulation on the downside. Look at the volume in here actually at just record levels coming up right now. And this right over here, we call that a hammer bottom, and that's very likely a bottom. So what we project is a rally up here into the high 30s, potentially getting up here to about $41. I doubt it. Much more likely that it's going to get up into these areas here and then fail again. So if you look, we talked about a low in July, right? Well, this low right over here is only April. So that shows you there are many cycles out there coming into July that are going to have a ton of risk in them and big volatility in the oil market. What are some of the evidence is that the oil market has been crippled, absolutely done. The energy markets will try to hold together in here. You probably will see natural gas do better than anything, because with the shale producers under huge stress and probably not producing because they lose money on every gallon they produce, they would be a source of natural gas being produced as they do that. But that is not going to happen. So there will be less natural gas out there. So natural gas could do much better than the rest of the complex now, and we were looking for a bottom in it. Some of the evidence is that energy will continue to have problems out into July, and even though it might rally up into the high 30s for light crude, that it's pretty likely that continued downward stair-step pattern will continue. Now let's look at the gold market, /GC. and we're going to look at the near term right in here and here. Now, I'm getting some emails and people writing to me, well, a flight to safety should be going on. You talked about gold going up to 1725, 1735 in the near term, though it got a rally and then stopped. And what's that all about? Well, first of all, we did get up into near resistance areas. That is true. If you look back at other periods of a flight to cash, the one that I could think about clearly, because I traded it so clearly, was 1987. And gold did well in the initial stages of that big crash, but then did very, very poorly after that as the deflationary forces hurt gold, silver, the other metals. Right now, gold is outperforming everything else. What our projection in here is that it might still be able to get up to those resistance levels at 17 and a quarter, 1735. But there's a correction due here and a declining phase into May in most of this complex, the metals complex. So we won't be surprised if gold does struggle, and then after that, way out over here, when the government is print, doing everything they can to save the collapse, that the gold market soars on the upside and gets up to, much higher levels. And you could look at our big picture analysis last week to see what those are. For the near term, you could see what gold did today, and that is tried to rally and then pulled back. There's a support buy zone right in here. You could see the minor patterns, and the blue ones is what we're looking at right in here. The dashed ones are silver, and I know that's confusing if you're not familiar with my charts. This is the dominant gold pattern right over here. So we're in a rally phase here and a rally phase here, but this looks like it's topping to me and likely to roll over and give you a correction. I wouldn't be surprised to see gold pull down to 1635 in this flight to cash period that we're in right now. And this is a buy zone in here, down to about 1618 right there. And we think that gold could be range bound in here between the low 1700s and the low 1600s while it's in a corrective phase. So that's a look at the weekly on the left, and which looks like it will be chopping around and then correcting into May. This depth of this decline right over here doesn't have to be that strong. We'll be updating that. This is kind of a natural movement that we see here. And you can see that if it's not rallying today, well, then when will it be? It's going to have to be when it's very clear that the government is building its balance sheet in a massive way. And I think that might be clear out into the springtime. So right now we're going to look for this range-bound condition in the gold market. I'm just going to blow up silver for you for a second in here so you could see the difference in silver, which is much more of a commodity that is based on the industrial demand around the world, and this is a much weaker condition that you see in here. So I want you to see that. And copper is also significantly weaker than that, and I'm going to show you copper right in here, as copper is in this red zone. Now these are our, when they're green and yellow and red, that's our favorable rising phases, corrective phases, or negative, and this is in a negative phase out here into April, May. So it made a lower low today, and copper is in huge trouble. So what I want you to see in there as we look at that is that the situation in the metals markets is very bad, and likely to see liquidations, forced liquidations going on in a lot of markets that are going to affect these markets, and even gold. And that is likely to see gold moving down when everybody would be thinking it would be moving up, because it's actually a deflationary condition. Now, what is helping gold a lot, and I'm going to switch over here from copper to the dollar market right in here. And here is the breakdown in the dollar. Now, we talked about this being a double top, and the fact that a low was formed right in here, nesting, and then a rally phase. it couldn't get through the resistance and then broke the VTL, valid trend line. You could learn about those in our cycle analysis workshop that we have. Please go to the SLIM site and see that cycle analysis workshop. For any of our marketing partners that have that on their site, please do go watch this and learn about the VTLs. That breakdown of the VTL coincided with a cycle support breakdown right over there. You can see that cycle support low, and now the dollar is in severe trouble. We're looking for a decline to 94 or lower, and it's 94.91 over this period into May. Right over there, it could be much lower than that. We think a dollar collapse is in hand, and this is about the United States printing money at who knows what kind of rate, and also the fact that there's been a massive convergence of interest rates. People have been hung long dollar denominated assets, borrowing money in Japan at zero and bringing it here into the US. Well, now they are getting crushed on those carry trades, and the dollar could be significantly lower for a long period of time. How long? Well, if I highlight this, that points out to September of 2021. That's when we think that this low is going to be made in the dollar, and it very well could be 20% lower than this. I'm just making up a number, but if you look at our big picture analysis last week, we showed you how the dollar fell 40-something% back the last time the Fed was in the condition to have to do this, to have to print to save, and that's where we are right now. So the dollar is going much lower, and that's why we think gold is going much higher, but not quite yet. That's your dollar pattern right there for the intermediate term. For the near term, right over here, we're looking for the dollar to get support. Now, we called, when the dollar broke this level right over here, we put this in here, configuration warning. In other words, the configuration of this pattern had turned negative and likely to continue down, and it did. Now we're developing sell zones that are falling in here, and this low right over here, yes, at about 94. So we're going to keep looking for another week and a half or so of a declining dollar, best case 94 right there, and that is a free fall that you see there, and likely to see much lower prices in the dollar index, as you can see on the weekly and on the daily. We will look for another week or week and a half of decline, and then a failing rebound in the dollar. Now, I'm going to show you something that I showed to our members a week or 2 weeks ago, I think it was, where I showed what we thought was a major bottom happening in the Japanese yen future. Look at these cycle patterns right in here. You can see the consistency of them. This, you can see, is that cycle right over there has about an average of about 23 weeks from every key low to every key low. That was 24, that was 22, that was 22. Positive, corrective, positive, negative, right through to the time frame. Positive, corrective, positive, corrective. A failure is the dollar got strong, and negative right into this time frame. Look at what the yen is doing right now. The yen is moving because people are shorted because they thought the dollar was the strongest thing on earth, but now we have a tone change of major significance, and the yen is probably going to go much higher than this. Look for pullbacks and choppy action, and then higher prices in the yen. I wanted you to see that. Once it broke out above this level here at about 95.85, it just exploded right over there. That breakout was very significant. We talked about the yen being significant. We also had a date for the bottom in the euro currency, and I'm going to show you that right over here. And we had talked about the period of dollar risk right over there. Let's just look at these last couple of cycles right over here, and we've had this right in here, the period of dollar risk, and sure enough, almost exactly on time. We expected February 29th. We expected February 14th approximately to be the time when the dollar peaked and the euro turned up. It was 2 weeks later that happened, but it absolutely happened, and this shows you what kind of problems that the dollar has. looking at the euro currency. So I wanted to go into some depth on that for you to see that the dollar is in a major risk, that what you see now as a chaotic condition and a big break in the dollar has likely only begun. And this could go out for many months, and like I said, it's projecting out into September of 2021. So rallies in the dollar are likely to be fake, and big declines are very likely to happen. So, we're focusing on the short term. The short term in the dollar, I just want to go back there so that you can see really quickly as I switch over to this chart right over here on the daily chart. The short term still says another decline for a week and a half or so, and then a feeble rally. So look for dollar weakness to continue in there. So now we're going to look at the extraordinary bond market. As we look now, switch over from the dollar, and we're going to look at the ZBs because that's the ones I trade, and the most traders look at the ZBs. Let's just look at the weekly pattern right over here. This is extraordinary. I cannot really keep up with the movements in here. As you could see, it got up above that projection right over there. It got to almost to that 261.8 fib extension. I would have never guessed that it could have done that. Now we projected low yields on April 6th and then June 22nd. We're still actually looking for that. So we can see the yields potentially staying where they are out here for another few weeks. In other words, the bond market continuing to be holding up in here and then going into some correction. I can see right now we're going to have to raise the corrective levels in here based on what we're seeing. But with yields at these prices right now, you can't expect that you're going to see the bond market move up much past that 192 area and that fib extension right over there at about 193. So we're just going to call that's the potential April 6th high, and then some correction, and then moving again to the upside in a continued panic in the markets. Here you can see this is continuing to move to the upside, and there again our projections are going to be raising here, but we're going to look for a hard time for this market to make a whole lot more ground, maybe getting up to 193 and then pulling back into the support zone in here, which is slightly higher than where we have it right now, and then getting another rally out into this April 6th area that we were looking for. So this, you get down into these areas right over here, 170, this is 177. Well, that would be a big break, and that probably would be a good buy in that area because the panics are not over in these markets, and we're going to look for a lot more in there. There's your weekly pattern right in there. And again, what we're looking for are Treasury corrective low to be synced into May. So the panic right in here should be over the first week of April, and then a correction in the bond market into the middle of May right over there. That's what we're going to look for. That's probably where the stock market calms down into that period, and then another huge collapse we think out into July. But I'm just talking to you right now without looking at the S&P charts. So now we're going to look at the stock market, and I'm going to do this differently than I have ever done, because what I want to show you is the S&P 500 on 4 different charts, so that you can see what we look at and why we have been cautioning that the market was in a lot of trouble. And honestly, I did not know the extent that it would break. You never know when a free fall condition is going to hit and how deep it's going to come. So I'm switching over now to the weekly chart of the S&P 500. I'm going to show you what our members see in the charts that were updated today and what the members did get. Now, first of all, let's just go a little further out in here. I want you to note that there are major cyclical patterns right in here and here. See how the low lines up right in here and then projects to a low here out in June, July. We have been talking about a major top and then a decline. We had said early part of the year that risk was increasing from mid-January into early March. We got fooled by this little rally right in here. This is what our original and what we came back to as the likelihood. Now, there's been a slight shift in here. You'll see the dotted line as these are extending out a little bit. What we're looking for, and I'll show you on the daily chart, is a bottoming occurring right in here. Here's your major 61.8, your cycle low support coming in right across there. And for now, we're going to say that the support right around 27.20 is an important one. Now, we're in free fall, and that's only 20 points from where we are right now. And if it broke through there, the next level would be over here at about 25.65. So that's the levels we're looking at. We think it could hold in here, but in this condition of the market, you just don't know. So we're looking at here, can it hold? And if not, then we're looking here at about 25.65, right at this level right over here, the major 71.8. If it broke to there right now, then this low over here that we're projecting in July would likely be down around here, which is 23.67. Coming out to the longer term. So you can see that it's pretty likely that July is going to get there and that we have some additional 400 points on the downside from where we are right now in the S&P 500, which is a pretty good percentage right there. And this all will have been the crash of 2020 that we're in right now. And it looks already like that in just 13 days, doesn't it? So these could definitely be lower than we're projecting right now. The key is what happens at this point. These yellow ovals are these corrective periods. You can see that. And this big one out over here could easily come way down here to this level or worse. Out into July, into the 2300s. So remember that when you get into these final stages right over here, like you did right over here, that's the collapse period right there where you get these major declines. And the one we're in right now is already worse than this because this is the first wave down right over here. And this was the first wave down right over here. It rallied up for about 5 weeks and then put on a big break again. That's like what we're looking at in here. And there is a lot of trouble when we look at this market. Best case we make really out into July is falling down to that area, right down over here into that 2500s right over there. And it's heaven forbid that they don't act properly, the Fed, and help the markets to move organically. You could be moving down here as the Fed continues to panic the market and do the wrong thing. So 23.65, let's just say that's what our target is over these coming months. Here is the short-term pattern. Now, these are 20-day cycles. You can see the clarity of the cycles. This is 22 days. This was 20 days. This was 20 days. This was 20 days. So perfect cyclicality. We are now 6 days into this cycle. There are 14 trading sessions, give or take, 2 or 3 either way. It could bottom early, it could bottom later. And here we are at this weekly chart support that I just showed you right in here. And if we break that, then again, I'm going to go back to the weekly that I just showed you. We fall down to these lower support areas right in here. I don't have them on this daily chart. So once we broke down underneath that support level, we had negative configuration going on. Cycle support breakdown negative indicates intermediate top, and you can see what happened. It broke down into the 20th day. It rallied into the sell zone and then collapsed again. This is your new sell zone right over here, and you could get a rebound up to this 2900 area. That's only 160 points. That could be an easy bounce, but if it happened, it's a screaming sell because the probabilities of continuing on the downside are so high. That would be, to me, a best case, a rebound to 2,900. And if we got that here in the next week, then I would say that would be the exit opportunity for the people that have been writing to me and asking, well, what do we do now? I missed the selling. Well, there's probably a lot more selling to come. And rebounds that occur are very likely to be opportunities. So what I just showed you right over here is what our member charts look like. And looking at the S&P 500, the NASDAQ, and the Russell. And when you blow them up, like I'm going to blow this one up right now, where I say maximize sell, you get right back to this chart. So what we're getting right now in here, and I want you to see, is the option bias indicator, one of our proprietary studies. This break right over here gave you a bottom warning. We call that a N1 orange, extreme oversold condition. I want you to note in the selling so far, it has not become extreme yet. It is slightly oversold, which is very interesting because that means there's been internals going on that are keeping it from being extreme oversold right now. You would think it would be. Maybe that will hit again pretty soon. But that's because the volatility numbers are going up so strongly, and when that happens, it changes, the formula automatically changes because higher volatility means it's less oversold. So what it looks like to us right in there is that you get a rebound, it's likely to be fake. You get back to yellow on here and neutral, man, I think that's the best you could possibly see in there. Now the next chart I'm going to show you in here is the slim ribbon, the condition chart, which shows you momentum. And this goes all the way back here about 6 months in time. This is back to September of last year right over here. And you could see the upward momentum that we were in through here. We had a little correction, went to neutral, and then turned positive again. When the projection oscillator gets down to oversold conditions, it gives you a long side indication. In other words, momentum is continuing. It's correcting internally positively in a positive way. Once this turns red, then it starts to give you sell signals, and you can see how fantastic this one was. You can see right in there. We also keep the market forecast indicator, which showed it very, very oversold right over there and about to get to that level also. So a slim ribbon giving you a negativity. What often happens is that it becomes support on the way up, it becomes resistance on the way down, and these are your daily chart extreme negative conditions that are existing right now and that likely say that we're going to continue to move to the downside. If this stays red and then this projection oscillator moves back up past the 75 level, that's going to be negative. Now I'm going to show you another version of this chart. So this helped us know that the markets were in a lot of trouble when that happened. And now take a look at this. This is our 2-hour chart right over here. And what I want you to see in here is that we do this for short-term traders. So here the short-term bias turned negative right at this level. And anytime the short-term bias is negative and the projection oscillator gets up to these levels above 75 or so, it is a sell warning that the market will move down again, and you see that happen here. You see that happen right over here. You got neutral here, and then you got another signal, and this is actually quite weak. You can see that. Our ASLIM market condition indicator is on here. The key is that it needs to be above the swing zone, which is between 25 and minus 25. When it crosses through it, it says longer term internals are taking over. It gives you negative conditions, and we have been in extreme weakness conditions right in here. We have that in all of the indicators, and you can see we can't really even get a rally that's significant over here in the projection oscillator to give you another sell, but these are all negative confirmations when you get in there. Here, when it was moving up, they were positive confirmations right there. So this is an unbelievable valuable chart, 2-hour chart that keeps you in the direction of the big moves. That's the key to this, and you can see right now it is in negative condition, and very likely that if we get a rebound, this is going to get overbought over here in this area, and it's going to turn down again. And like we showed you on the daily chart, it has another 12 or 14 days to go of these conditions. So this is extremely negative condition that we're looking at, and very likely to continue. Just to review in here, I'm going to go back. Momentum on the daily, extremely negative in there. The cycle pattern on the daily pointing to declines coming for the next 2.5, 3 weeks in there. And here is your pattern in here that is pointing to a bottom likely coming in this market in the next couple of weeks, aligning with that daily pattern, and then a rebound period that should last a number of weeks before the next free fall comes in. That is our special report. I hope I made it really clear to you. This type of condition in the market does not clear itself fast, and when it does clear itself, it's likely to be fake. You go back and look at the charts of, 1987. I mean, it broke in a giant way and then rebounded in a pretty significant way and set a hook. There are a lot of bull market tops that had big breaks off of highs, let's say 12, 14%, and then had rallies back of maybe halfway, and then moved down very significantly again. I think something is going to happen in a rebound starting in a few weeks, and that is likely to be false, and markets moving down again. So, I showed you the analysis. I gave you my opinion on the conditions. If Powell is smart, he will let these things clear on their own. You may go back and read about the depression that nobody really knew about. And that is 1920, 21, where the government just stood aside and everything cleared. And then, of course, we got into the roaring 20s after that. So the best thing for the Fed to do is nothing, and we'll see if they've got the cojones that it takes to let the markets take over and just let everything clear, and for them to do nothing but to manage the decline in here so that we can have a real organic economy and economic conditions in here when the coronavirus burns itself out and things get back to some normalcy in this world. A normalcy that probably has oil trading between $20 and $35 for a long period of time. That is it. I hope that it was amazing information for you, that this is very valuable to you. This is going to be a public viewing video because we want everybody to benefit from our work, and I want everybody to see our work and see the value of being an Ask Slim member. You want to know more? Write to Matt at AskSlim.com. That's it, and I will see you in the next segment.